Hello everyone. In the prior session, we explored the advantages and disadvantages of a corporation. Today, we will dive deeper into the foundational step of how to start a corporation. Simply put, we are going to discuss how a corporation is born, which is the process is called incorporation. And what does this process entails? First, we will discuss the incorporation itself, how to legally form a corporation. Now, a corporation is formed via a state, and each state will have a different instruction and requirement of how to organize your organization, how to start. Nevertheless, all of them, they will require you to incur some expenses called organizational expense. We would look at organizational expense. Also, we would look at the corporate management structure. When you form a corporation, and here we are looking at large corporation, there's a management structure. There are certain titles, the CEO, the CFO. What is this structure? And who's on the top? Who's on the top? It's always the shareholders, the owners of the company. So we will discuss the shareholders' right. And what evidence do they have that they own the stock? We'll talk about the stock certificate and how the stock is transferred, the stock transfer. And what are your rights as a shareholder? What can you do? What can you not do? Because you're on the top of the pyramid. You're the owner of the company, but you have certain rights. We'll talk about this. This session, simply put, is aimed to provide you a basic overview of U.S. corporate structure. Why? We're setting the ground to discuss a little bit more in depth the concept of common stock. Common stock is an accounting term. So it's essential to look at the big picture, to grasp the foundational terms before we dive into the accounting aspect of corporate accounting. And this topic will help you also in finance. Let's go ahead and get started to see how a corporation starts, so on and so forth. Let's get going. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great. You are looking for some additional help, and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website. Starting with the incorporation process, this is where the corporation is born, is officially born. Now bear in mind, although we say the corporation is officially born, this business might have been in business for many years. For example, they started the business in year 2000, and after 20 years or 30 years or 2 years or 5 years, it does not matter, in 2027, they decided to incorporate. Well, we've been in business for so long, and after 27 years, we incorporate. Incorporation means officially becoming a corporation. You could be a business, just sole proprietorship, then you incorporate. So bear in mind, although I am given the impression is when the business is born, like when the baby is born, this is when the official papers are filed to form officially a corporation. So a corporation is created, is born through a formal process involving the acquisition of a charter from state government. Well, the other thing you need to know, each corporation is born in a state. In other words, you file with a state to have that business incorporated in that state. There's no such thing as a federal corporation. There's no such thing as a federal corporation. Corporations are incorporated in states. Now, in the United States, the most popular state where businesses incorporate in. Matter of fact, my company, Farhat Lectures, is incorporated in, is the state of Delaware. Why? Because they have no state income tax. Simply put, when the corporation makes a profit, they don't have to pay state income tax. You pay federal tax, you pay state tax, you pay individual tax. If you're a corporation and if you corporate in the state of Delaware, you don't have to pay state income tax. And that's why the majority of corporations are incorporated in Delaware. Now, don't think of this process as a very complicated process. It's basically a form. You file, you fill out the form. If you don't know what you're doing, you hire a lawyer. For example, I hired my lawyer. I paid him a fee and they incorporated my business in the state of Delaware. Now, if it's a large corporation, many investors, you need a prospective stockholders to file, to sign the chartered application. For my situation, I'm the only person. I sign the paperwork, I send it to the state with the fee, thus a corporation is created. The prospective stockholders are called incorporators or promoters, sign an application, a chartered application. The application then filed with the state along a fee. You have to pay a fee. You could even download from the state government of Delaware. You can download the application and take a look at it. So upon completing the application process and paying the necessary fee, the state issues the corporate charter officially forming a corporation. Then they send you a PDF application saying this is your paperwork. If you want to go to the bank, get a loan, open a business account, you will show them this paperwork. This business is officially a corporation. Then, once you are incorporated, you can ask the state how many stocks you want to issue. Investors purchase corporation stocks. For example, when you file for the paperwork, you tell them, I want to issue 1 million shares, or you want to issue 1 share if you're by yourself, or 50 shares. It does not matter the number of shares, but once you issue those shares, you can sell those shares to new investors. Also, you will have a meeting of stockholders to elect the board of directors. Again, in my situation, I just want to simplify the process in a sense that it's not a complicated process. If it's one individual, I am the board of directors. I'm the CEO. I'm everyone. If it's a larger corporation, then the stockholders will meet. Then they have to elect a board to run the company, which we'll talk about that later shortly in this session, how the corporation is run. Then you would run the corporation, because remember, the board of directors is running the corporation on behalf of the stockholders, which we'll talk about the role of the stockholders. Now let's talk a little bit more about the incorporation process. I told you I hired a lawyer to file the paperwork. I might hire a consultant. I might hire an accountant. I might hire an auditor. I might incur additional fees in this process, in the process of incorporating. Those fees are called organization expenses, are also known as organization costs, are the expenses. So if they're organization expenses, it means they are expensed. They are not capitalized. It means you go ahead and you write them off on the income statement. Now, bear in mind, they're treated a little bit differently for tax purposes. We don't have to worry about tax. We're talking about financial accounting here. They would include legal fees. For example, you pay the lawyer to help you out. Promoters fees, people that help you promote the corporation to raise fund during this process. Payment made for obtaining the charter. All of these are expensed, and the expense is called organization expense. They are recorded as a debit to expense, and they are expense as incurred. So just know that the expenses incurred during the incorporation process are expensed. And the reason why they are expensed and not capitalized, because we don't know their future benefit. The corporation might fail, and there's no reason to assume these fees will provide any future benefit. Therefore, we expense them. That's the idea behind it. Because what's the option? When you make a payment, you either have to expense or treat as an asset. When you treat something as an asset, you are assuming there's a future benefit to that asset. Well, we don't know what's the future benefit of this by incorporating. Therefore, just like advertising expense, we expense it. Now let's talk about how a corporation is managed. The structure of corporate management. First, you have the stockholders on the top. It's going to tell you this is the top. This is the hierarchy, the stockholders. So if these are the stockholders, the owners of the company, the stockholders would elect
the board of directors. So if we said this is the top, this is number one, this is the second level, this is the board of directors. Who elects the board of directors? Who chooses? Actually, there's an election. And for each share of stock, you have one vote. So the more shares you have, the more votes you have. You vote with your money, with your monetary power. You vote the board of directors. Now, the board of directors, they oversee corporate activities, hires or fires key executives who manage day-to-day operation. So I'm going to say number two is BOD, board of directors. The board of directors will hire the CEO, the CFO, the CIO, and all other upper level management to help them run the company. Now guess what these people will do? They will hire people below them to run the company. Usually the CEO is on the top. The CEO will basically will be here, right below the board of directors. So the CEO, often the corporation president, leads corporate operation with support from several VPs, vice presidents, overseeing specific areas like finance, production, and marketing. So you have the CEO, and the CEO will have a VP of operation, VP of finance, VP of marketing, so on and so forth. For example, in my company, I'm by myself and I do have a VP of operation that helps me run the company, but I am the shareholder, I am the only shareholder, the board of directors, the CEO. I have somebody who's helping me, VP of operation, that works for me. But the point I'm trying to make is these are all positions depending on how large or how big is the company. A corporation holds at least one annual stockholder meeting to elect the board of directors. Again, in the case of Farhat Lectures, I elect myself automatically. I have no competition. I'm all the stockholders, and I can vote anyone, and I'm voting myself to run the company. So another corporation where they have millions of shareholders, then the shareholders will vote. Now, if you own stocks in a company, let's assume you own stocks in Apple Computers or Amazon or Walmart or any company, the stockholders, if you cannot attend the meeting, so let's assume there's a voting issue, you can delegate your voting right for an agent through a proxy. So what is a proxy? Let's assume you own stocks in Microsoft or Walmart or one of those large companies. You can assign your vote to someone else. You can tell someone else you can vote, you can take my vote and vote on my behalf. And this happens a lot, where, for example, one, they call them active shareholder, someone who cares so much about the company, but they don't have a lot of shares. They may go and talk to smaller shareholders and ask them, would you grant me the right to vote on your behalf? And if you agree, you give them their votes. Remember, the more votes you have, the more power you have. So this is called a proxy, a document authorizing the agent to vote on their behalf. Now, bear in mind, we have a corporate bylaws, and the corporate bylaws are really filed with the article of incorporation. It tells you how we are running the company, how the company is governed, when do we meet, how do we elect, so on and so forth. Now let's focus here on the top. We said, who are the top? The stockholders are on the top. So if the stockholders on the top, well, what can they do? What they cannot do. So what are the stockholders' right? The people on the top. Well, they have specific right defined by the corporate shareholder and state laws. And I'm going to give you some common rights that applies in most situations. The first right you have is to vote the board of directors. Simply put, you are the owner. You select them, or you can delegate, as I told you, via a proxy vote. You can give your vote to someone else, or you can vote. And that's the most powerful thing you have as a stockholder. You can also, you have the right to sell or transfer your ownership of the stock. For a corporation, that's very easy. In a partnership, it may not be as easy, because in a corporation, if you own stocks, you can sell your stocks to other shareholders. You can sell your stocks to an outside party. You can give your stock to your kids. You can do whatever you want to. So that's part of your rights. It's easy. Remember, we talked about one advantage of having a corporation is the transferability of ownership relative to having a partnership. In a partnership, it's not as easy sometimes. Sometimes in a partnership, to sell your share or to sell your ownership, you have to get the consent of all other partners. In some partnerships, it's a little bit more challenging. You also have what we called a preemptive right. What is a preemptive right? So the shareholders have a preemptive right. What is a preemptive right and how does it work? Let's assume, for the sake of illustration, you own 100 shares in a company with 1,000 shares. So the total is the denominator, 1,000 shares, and you own, I own 100 shares of a company. 100 out of 1,000 is 10%. So right now I own 10% of this company. Let's assume the company means the shareholders, decided to issue, they want to kind of, raise more money, and the company decided to issue new 50,000 shares. We want to sell 50,000 shares from the company to new shareholders. Here's what's going to happen. If this is going to happen, I have the right to get 10%, means buy, not to get, to buy 10%. So what is 10% of 50,000? 5,000 shares. So I have the right to buy an additional 10%. The right, not the obligation. So don't confuse right with obligation. What do I mean by this? What I mean by this is, if I choose not to buy, not to invest money, I do have that right. But they have to come to me first and ask me, would you be interested? You have the first stake if you want to buy 5,000 shares. Now, if I do buy 5,000 shares, here's what's going to happen. If I buy 5,000 shares, I had 100 shares in the past, I buy an additional 5,000. Now the company has, in total, they had 1,000 before. Now they add 50,000 to the denominator, and I still own 10% of the company. So if I do exercise my right, I keep my ownership level of 10%. If I buy less than 5,000 or buy none, they're still going to issue the shares. If I don't buy the shares, what's going to happen to my ownership? It's going to drop substantially. It means my ownership gets diluted. My ownership gets diluted. It means what? It means I don't have a saying. I don't have a saying in the company. And what does that mean? It means I lost ownership. Technically, I lost ownership. Now, if you ever watch The Social Network, the movie called The Social Network, it's how Facebook was created, a movie about Facebook, how Facebook was created. The main idea of The Social Network is one of the co-founders of The Social Network, specifically his name is Eduardo, lost his preemptive right without knowing. So generally speaking, you have a preemptive right. But can the company take away that preemptive right? Sure, but they have to tell you. In the case of Eduardo, he claimed that Facebook took his preemptive right. Watch the movie if you're interested in, looking at this. They took his preemptive right without him knowing. And if you watch the movie, you'll see when he signed the new corporation, he did not really read it. He believed they tricked him. That's beside the scope of this lesson. But watch the movie if you're interested. So the preemptive right gives you the right to buy proportionate share of any new stocks issued, protecting your interest in the corporation. In case of Eduardo, he used to own 18% of Facebook. Then after the new shares, his ownership, I don't remember, it was below 1%. So they took away his ownership level kind of in a swift way. Unethical, I would say, if that's exactly what happened. Also, as a shareholder, you can receive dividend on each share of common stock if declared. And we'll talk about dividend later, but if you're a shareholder and you own one stock and they issue dividend, you have the right to receive a proportionate amount of that dividend based on your ownership. So if they issued $100,000 in dividend, you own 10%, you'll get 10% of the dividend in proportion to your ownership. Also, in case of liquidation, in case the company goes out of business or they want to close the business, you get the remaining asset. What does that mean? It means you're the last person in line to get anything, if anything left. You have to pay the creditors first. There's a list of who gets paid first. Preferred shareholders, we'll talk about them. The creditors, there's a long line in front of you. You're the owner. You're the last person who's going to get anything when the company go bankrupt. Now, bear in mind, I mentioned that the preemptive right can be taken away because it's basically however the company decides to run this corporation. Also, certain shareholders may not get the voting power. For example, Google Class C shares, they have no voting power, and other classes of stocks. And this is basically a new phenomenon for the new technology companies where the owners are still there, the founders. They don't want the shareholders to vote. They said, okay, you want to buy our stock, go ahead and buy it, but we're telling you up front, you have no voting power. So you can share in the profit. You are a shareholder, but you have no voting power because we, as the founder of the company, are not giving any right to you. And if you trust those owners, you go ahead and you give it to them, like Google. Now let's talk about stock certificate and stock transfer. Now when you own stocks, back in the old days, you actually own the stock. They would send you a piece of paper, a stock certificate, as a proof that you own the stock. Now, 15, 20 years ago, that's no longer the case anymore. Why? Because to print this stock certificate, it costs money for the corporation. Actually, you don't want it. As a shareholder, you don't want the company to spend money. Therefore, if you own stocks now, it's a computer entry somewhere. That's your proof. Now, when I was in practice, when I worked with Merrill Lynch long time ago, and that was the year 2000, I still remember people calling us. People means potential customers calling our office saying, I would like to sell my stock. And I would say, great, what's your account number? It's like, I don't have an account number. It's like, how are you going to sell your stock? And the individual would say, usually they're old people. They would say, well, I do have the stock in my hand. I would like to sell it. I heard on the news that I can sell it over the phone. I would say, yes, ma'am, sir, you can sell it over the phone, but first you have to deposit. You have to come to the office, give us the stock certificate, open an account. You would open an account, deposit this stock certificate with us. You will deposit with us. Then we will create an account. So let's assume you own 100 shares of Apple. Then we'll give you 100 shares of Apple, a computer entry. Then you can sell it online what you heard about this. But if you have it in your hand, you have the stock in your hand. You cannot sell it over the phone. Once again, it's less and less common. Now, if you visit Disney, if you happen to visit Disney, inside Disney stores, you can buy an actual Disney stock. Now, how do I know this? One of my students, when I covered this lesson, I remember her name is Michaela. I don't know why I remember her name, but I do. Michaela brought the Disney stock. She had it framed. She's like, okay, this is stock certificate, and we passed it around to show that you can issue a stock certificate, an actual stock certificate. And I asked her where did she get it from. She said, if you go to Disney, there are stores and you can actually buy it. And how much will you pay for it? Whatever Disney stock is selling at for that day, whatever that Disney stock is, that's the price of that stock. So a stock certificate typically include the company name, the stockholder's name, number of shares, for example, in Michaela's situation, 1 shares, and any other relevant detailed corporation whose stock is publicly traded, often engage. Also, you'll have the registrar or registrar name. What is that? Someone other than Disney keeps track of the name of the owners, their addresses, their social security. Now, why would they do that? Well, when Disney pays dividend, they have to get you the money. How would they do that? They will need your name, your address, so on and so forth. Who keeps track of that? A registrar company. There are companies that's what they do. They're called registered or transfer company. Let's assume Michaela, for the sake of simplicity, one of her classmates decided to buy that stock from her. Well, then the name on that certificate will have to be transferred from Michaela to someone else. Who will do this transfer? This registrar company. They will transfer the name, the address. Now, if it's a computer entry, they can do it electronically. When you sell your stock, you don't know who you sell it to, or when you buy stocks, you don't know who you're buying it from, but the registrar company will keep track of that. So a transfer agent is to assist with stock purchases and sales. Those are typically large bank or trust that keeps track of this. The name, when you buy, sell, usually it's the same one. Sometimes there are 2 different companies. It does not matter, but that's their role. A transfer agent or a registrar, they could be the same. They could be 2 separate companies. And this is an introduction for some terms. We're not done with the introducing the corporation, but that's enough for this session. What should you do? You want to go to Farhat Lectures, look at additional resources, maybe some multiple choice questions. In the next session, we will cover additional basic terms to set the ground for issuing stocks from an accounting perspective. You have to know the background. That's why it's important to know the theory before you start to get into the actual numbers. Invest in yourself, of course. Study hard. Visit farhatlectures.com for additional resources.